Banks borrow, lend, and earn the spread. They raise deposits and borrow in capital markets, and they invest most of the proceeds in loans and bonds. We know this already. What might be less obvious is that banks borrow short and lend long. Their investments tend to be longer maturity than their liabilities. Mortgages can mature in 20 years, whereas deposits have maturities of less than 1 year. Checking accounts are zero maturity. In this session, we will discuss how this maturity mismatch between the assets and the liabilities creates interest rate risk. We will define this risk. We will introduce two channels that connect interest rates to the profitability and valuation of a bank. And in a final step, we will discuss how banks control interest rate risk. Interest rates are volatile. This is just a fact of life. Here is data showing the federal funds rate over a long time horizon. This interest rate is tied to the monetary policy of the US Federal Reserve System. Right now, we are not going to discuss where this interest rate comes from, but we can see it is volatile. There were wild swings in the 1980s. Since 2009, interest rates have been unusually low and stable. The belief is that these rates will eventually lift off, but the precise timing is uncertain. Why should banks care? Well, uncertainty means risk, and in this case, we have uncertainty about interest rates. Our goal is to understand how and why movements in interest rates might impact bank cash flows and bank valuations. We will see that maturity mismatch between assets and liabilities plays a central role. Let's start with the pathway from interest rate volatility to bank profits. This is called the cash flow channel. It focuses on a bank's interest income and interest expenses, and it works as follows. Banks make investments in loans and bonds. The earnings on those investments depend on the interest rates. If interest rates are high, that's good news for the bank. It can earn higher income on its loans. Here is the interest rate on newly granted 30-year fixed-rate mortgages in the United States. A mortgage that was granted in the year 2000 and held for 30 years will earn higher interest income than a mortgage granted in 2010 or 2020. Banks often fund those investments through borrowing. This suggests that higher interest rates might be bad news for a bank. Here is the 3-month interest rate on certificates of deposit, also known as CDs. CDs are a short-term bond that some banks issue to fund their investments. When this rate increases, banks have higher interest expenses. So, are banks better or worse off when interest rates rise? Well, it depends on the bank. Here is a bank that borrows short and lends long. This is a fairly typical bank. It has $100 of assets that mature in 2 years. Let's say these assets pay 5% interest per year. This is a fixed interest rate that pays out each year. This investment is funded with borrowing. The borrowing costs are 4% per year. But the borrowing is short maturity. It needs to be refinanced at the end of the first year. The bank makes a net interest income, that's interest income of $5 minus interest expense of $4, so net interest income is $1 in the first year. What about the second year? Well, that depends on the borrowing rate a year from now. There is refinancing risk. If the 1-year borrowing rate increases from 4% to 5%, then the bank makes no profit. Any higher than that, and the bank loses money. From a cash flow standpoint, a bank's exposure to interest rate risk depends on when its assets and liabilities mature. Whether a financial instrument is fixed or variable rate matters as well. With a variable rate loan, a new interest rate can apply almost immediately. Long-term assets with fixed rates are insensitive to interest rate changes. They have rates that are locked in for a long time. Conversely, short-term or variable interest rate loans will be more sensitive. Let's put that all together. Suppose that interest rates go up. Interest income will increase. Interest expense will also increase. What about profits? That's the difference between income and expenses. The overall impact is unclear and it depends on the bank. We can also connect interest rates to the valuation of our bank. To understand how this works, let's start with the pricing of a bond. This is a bond that pays a fixed coupon each year and then some lump sum at maturity. The market value of this bond is given by this formula. It takes those future cash flows and discounts them back to the present day using the interest rate. When interest rates rise, we discount by more and the value of the bond decreases. This means that longer dated bonds, those are assets with a larger N, will lose even more value. On the other hand, the price of short-dated assets is less sensitive to changes in interest rates. We can throw out all of these higher power terms and we just have discounting by the gross interest rate. Here's the fun part. We can think about a bank as a portfolio of bonds on the asset side of the balance sheet. Conceptually, the bank's liabilities, which are deposits and other borrowings, also resemble bonds. We can value all of these assets using our bond pricing formula. We can value the liabilities the same way. And then we can also value the bank's equity. Remember, the value that flows to the shareholders is the value of selling the assets at market value, paying down the debt, and then pocketing the difference. Interest rates will have an impact on this calculation. When interest rates go up, what happens? Well, according to our bond pricing formula, the value of the asset portfolio will go down. The value of the liabilities will go down as well. The overall effect on the bank's equity is ambiguous. That's what I've noted here. However, banks typically have longer dated assets and shorter dated liabilities. So from a valuation standpoint, this means that assets are more interest rate sensitive than liabilities. This means that higher interest rates are usually bad news for banks. If maturity mismatch is the root cause of interest rate risk, then bank managers can try to close this gap. For example, if a bank issues a 5-year CD, then it could invest the proceeds in a 5-year mortgage loan. This helps, but as a general approach, it presents a major problem. Banks make a profit by meeting the demands of their customers. Savers like convenience. Many deposit accounts can be emptied on demand. They can be zero maturity. On the other hand, borrowers prefer long-term loans. Maturity mismatch is fundamental to the lending business. To get around this problem, risk managers have several other tools at their disposal. This includes the use of derivatives. Interest rate derivatives can be used to transfer the risk of volatile interest rates to a third party. Interest rate swaps, which are by far the most popular product, allow a bank to exchange a variable interest payment stream for a fixed stream. For a price, this will take interest rate risk off the table without disrupting our customers that want short-term deposits or long-term loans. Diversification into non-interest income has been the other popular approach. Since the late 1990s, banks have emphasized fee income coming from outside of the commercial banking business. Investment banking, insurance, underwriting, brokerage services, and so on. Profits from these business lines may be less sensitive to interest rates. Let's wrap up. Interest rates are uncertain. Changes in interest rates can have a direct impact on interest income, interest expense, and therefore bank profits. The market value of a bank will respond to changes in interest rates as well. This happens through a discount rate channel. In both cases, maturity mismatch between assets and liabilities plays a central role. Finally, we provided a brief overview of how risk managers can mitigate interest rate risk. Closing maturity mismatches is the simplest approach, but other methods may be less disruptive.